You ever notice how every real estate agent, influencer, and self-proclaimed entrepreneur on Instagram seems to be driving the exact same car? I'm talking about the Mercedes G-Wagon. You know the one. It's that boxy, military-looking SUV that costs more than most people's houses used to cost. And you're sitting there thinking, how are all these people affording $150,000 cars? Like, are they all secretly millionaires? Or is there something else going on here that nobody's telling you about? Here's the thing, and this is where it gets interesting. A lot of these people aren't actually affording these cars in the way you think they are. They're writing them off. As in, they're using a legitimate tax strategy that lets them deduct the entire cost of that vehicle from their taxable income. And before you roll your eyes and think this is some sketchy rich person loophole that doesn't apply to you, just hang on, because understanding how this works might actually change the way you think about business expenses, taxes, and building wealth in general. My name is Frank, and I spend way too much time thinking about money, tax strategy, and why some people seem to keep more of what they earn while others hand half their paycheck to the government without even questioning it. And look, I'm not here to tell you to go out and buy a G-Wagon tomorrow. Honestly, that's probably a terrible idea for most people. But I am here to explain how this whole tax write-off thing actually works, because once you understand it, you start to see opportunities everywhere. So today, we're going to break down the infamous G-Wagon tax loophole, why it exists, which vehicles actually qualify, and then, and this is the really valuable part, we're going to talk about all the other expenses you can legally deduct that nobody ever mentions. Because here's the truth. The tax code is basically a giant instruction manual for how to keep more of your money, but most people never bother reading it. All right, so let's start with the G-Wagon thing, because that's what everyone wants to know about. Why is it always a G-Wagon? Why not a Porsche? Why not a Ferrari? Well, it comes down to something called Section 179 of the tax code. And I know that sounds boring already, but stick with me because this is actually kind of fascinating. Section 179 is basically a part of the tax code that allows businesses to deduct the full purchase price of certain equipment and assets in the year they buy it, rather than depreciating it over several years. The idea behind it, and this is important, is to incentivize businesses to invest in equipment, machinery, and vehicles that they need to operate. So if you're a landscaping company and you need to buy a truck to haul your equipment around, the government's like, cool, we want you to grow your business. So go ahead and deduct that truck. Now here's where it gets spicy. The tax code has this weird rule about vehicles. Normally, there's a limit on how much you can deduct for a passenger vehicle. It's around $20,000 for the first year, which honestly doesn't even cover a basic sedan these days. But, and this is the big but, if the vehicle weighs more than 6,000 pounds, it's classified differently. It's not considered a regular passenger vehicle anymore. It's considered equipment. And equipment, you can deduct the whole thing, up to the Section 179 limit, which in 2024 is over $1 million. So basically, if you buy a vehicle that weighs over 6,000 pounds and you use it for your business, you can potentially write off the entire purchase price in 1 year. The G-Wagon weighs about 6,100 pounds. Boom. Qualifies. Range Rover? Yep. Cadillac Escalade? Absolutely. Even some of the bigger pickup trucks, like the Ford F-250 or the Ram 2500, they all qualify. And this is why you see so many business owners driving these specific vehicles. It's not just because they're flashy, though let's be honest, that doesn't hurt. It's because they're literally getting a massive tax break for buying them. Now, before you start thinking, okay, I'm going to go buy a G-Wagon and write it off, let me pump the brakes here for a second, because there are some real important details that people conveniently leave out when they're flexing their new ride on social media. First of all, you actually need to have a business, like a real business, not just an LLC you filed last week with zero revenue. The IRS isn't stupid, you know? They're going to want to see that you're actually running a legitimate business that generates income. If you're a W-2 employee with no side business, you can't just buy a G-Wagon and write it off. That's not how this works. Second, the vehicle has to be used for business purposes. And here's the kicker. The percentage of business use matters. If you use the vehicle 100% for business, you could deduct 100% of the cost. But if you use it 50% for business and 50% for personal use, you can only deduct 50%. And the IRS is pretty strict about this. They want to see logs, documentation, proof that you're actually using this vehicle for business. And third, and this is the part that people really don't want to talk about, you still have to spend the money to save on taxes. Like, let's say you're in the 30% tax bracket and you buy a $150,000 G-Wagon. Yes, you can write it off, which saves you about $45,000 in taxes. That's huge, but you still spent $150,000. You're not coming out ahead here unless you genuinely needed that vehicle for your business anyway. This is honestly one of the biggest misconceptions about tax write-offs in general. People think, oh, I can write it off, so it's basically free. No. Writing something off means you don't pay taxes on that amount of income. It doesn't mean you didn't spend the money. If you're spending money just to get a tax deduction, you're doing it wrong. You're still losing money, just slightly less than you would have otherwise. So the smart play here isn't to go out and buy a luxury SUV just because you can write it off. The smart play is to understand the rules so that when you do need to make a business purchase, whether it's a vehicle, equipment, software, whatever, you're maximizing your deductions and keeping as much money in your pocket as possible. All right, so that's the G-Wagon thing. But here's where this video actually gets valuable, because a vehicle deduction is just one tiny piece of a much bigger puzzle. There are literally hundreds of legitimate business expenses that you can deduct, and most people, even people who own businesses, are leaving money on the table because they just don't know what's deductible. Let me walk you through some of the big ones that people miss all the time. Home office deduction. If you work from home, and I mean actually work from home, not just check your email in your pajamas once a week, you can deduct a portion of your housing costs. Rent, mortgage interest, utilities, internet, even home repairs. The catch is that you need a dedicated space that's used exclusively for business. You can't just claim your living room where you also watch Netflix and play video games. It needs to be a specific area, like a spare bedroom or a corner office, that's used only for work. Business meals. This one's interesting because the rules changed recently. Used to be you could deduct 50% of business meals. Then during COVID, they temporarily bumped it up to 100% to help restaurants. Now it's back down to 50% for most meals. But here's what qualifies. Any meal where you're discussing business with a client, partner, or potential customer. Travel expenses. If you travel for business, and I mean legitimate business travel, not just taking a vacation and calling it a business trip, you can deduct basically everything. Flights, hotels, rental cars, meals, even tips. The IRS is pretty generous with this one, as long as the primary purpose of the trip is business. But here's the most important thing I want you to take away from this video. Don't spend money just to get a tax deduction. That's backwards thinking. The goal isn't to spend as much as possible so you can write it off. The goal is to build a profitable business and then strategically use the tax code to keep as much of that profit as possible. So no, you probably shouldn't go buy a G-Wagon just because you can write it off. But you should absolutely understand how deductions work. Track your business expenses and take advantage of every legitimate deduction you're entitled to. Because at the end of the day, the tax code is complicated and confusing on purpose. It's designed to benefit people who take the time to understand it. And now that you understand how this stuff works, you're in a way better position than 99% of people out there who just hand their taxes over to someone else and hope for the best. All right, that's it for today. If you found this helpful, do me a favor and hit that subscribe button. I make videos like this breaking down personal finance, tax strategy, and wealth building in a way that actually makes sense. Drop a comment below and let me know, are you taking advantage of any business deductions, or are you still learning how all this works? I read every comment, and I love hearing from you guys. Thanks for watching, and I'll see you in the next one. I'll also really need those subscriptions and engagement because Mr. Burns and his friends are trying to sue me for exposing some of their tax loopholes. Might need Homer's help in the next one.